Let's begin here by taking a look at the high quality demand zones. To find these zones, what we are looking out for is strong lows. The strong lows here are created from the move that breaks structure. So for example, right here, we have a break of structure, which makes this low right here a strong low. So let's say we have a candle that looks something like this here, and then we see a strong green momentum candle like this. When we see this type of move happening at a strong low, we can draw out a high quality demand zone. And remember, we draw the zone from the highest point of the previous candle down to the lowest point. We want to include the wicks here, and then we drag out the zone to the right. So this right here is our demand. And what we're looking out for is that we want the price to come back down to this demand area. And because we saw demand coming in the past, or in other words, we saw an imbalance between demand and supply in the past, we expect demand to come in here in the future as well. And to confirm the entry signal right here, what I'm usually looking out for is some kind of candlestick pattern or another price action signal to confirm the entry. One important thing to notice here is that let's say that we found another demand area from this strong low right here. So this right here is another strong low because it caused a break of structure. One important thing to notice here is that the price will definitely not always go down all the way to the demand area. Many times the price will reverse before the demand area appears. And later on in this course, when we talk about fair value gaps, we will talk about how we can find good entry points even if the price doesn't hit our supply or demand. But now then, how do we find our high quality supply zones? Well, the principle here is pretty similar, but the opposite. So what we are looking out for now is actually strong highs. And remember, a strong high is a move that breaks structure. So for example, this move right here is not a strong high. Why is this not a strong high? Well, because the move from this point failed to break structure. Remember, in order to break structure, the price needs to push below this point right here. Once again, this right here is another weak high because this move failed to break this low right here. But if you take a look at the third high right here, we can see that this move actually managed to break the previous low, causing a change of character. And because this is a strong high, we can look out for a high quality supply zone at that area. So let's say we maybe had a candle that looked something like this at this point, and then we saw lots of supply coming in. So we have a red candle, strong red candle right here indicating supply. And remember how to draw our supply zone. We include the previous candle, we draw out the supply here to the right. And our goal here is to basically wait for the price to potentially come up to the supply area and then reverse to the downside. Once again, to justify a short position, I usually look out for some kind of signal coming in at this supply area. It can be a bearish candlestick pattern or simply a strong bearish momentum candle. But we want to see some kind of indication that we actually see supply coming in again at that area. So now let's take a look at a real life example of high quality demand. And as we can see on this chart, we had our first break of structure right here. So it's possible that we can find some demand at this low. But in this particular case, you can see that we had one candlestick right here. This was actually a bullish hammer, which on its own is a bullish reversal signal. So this right here was actually a potential trade. However, we can see that the next candle here was a green candle, but it wasn't really showing momentum. The third candle after this low was a strong momentum candle. So one could argue here that we could draw out a demand area from this candle right here. But the reason I did not choose to draw out this demand area, even though we actually saw a bounce, a beautiful bounce coming in at this level, the reason I did not draw out this demand area is that I prefer the demand to come in very near the low. So let's take a look at the second example. You can see that we had another break of structure right here. Beautiful break. We had a strong breakout candle above the break of structure, which is a good sign. We also had a sort of tiny liquidity grab here before the breakout appeared. But what I want to focus on is this area right here. So you can see that on this low, we saw a very strong momentum candle. This is an indication that we are seeing demand coming in. So as you guys know by now, what I did was that I took the previous candle and I draw out a demand area. And also remember here that before we can draw out this demand area, we need to see the break of structure, because if we don't see a break of structure, we don't know if this right here is a strong low. But after this break of structure, the price went up and printed a new high. It came down here, went up again, actually tested this high, and then eventually we fell down all the way here to the demand. And this took quite a few candles, and this is an important part when it comes to trading supply and demand, is that we need to be patient and wait for the price to come back down to the demand area before we take a potential entry. It's much better to be patient rather than to force trades. Forcing trades is never a good idea, and it will often lead to losses. But what we can see here is that when the price came down and tested the demand, we actually saw a bullish signal, because the price right here printed a bullish hammer. And from this point, the price just went straight up here, and we even caused another break of structure, which means that this uptrend continues. But now you might of course wonder, where do we enter? Where do we place our stop loss and target levels? And here there are quite a few different methods, but let's take a look at a very simple way of doing this. So the entry point is pretty straightforward. You can enter at the candle close of the candlestick pattern or candle that confirms the demand zone. As for your stop loss, one way to set it is to set it below the lowest point of the actual pattern, or another common method, and this is very common, is to set the stop loss just below the actual demand area. As for your target level, many traders will actually take a target above the break of structure, because when we are in an uptrend, the bias is that the uptrend will continue, or in other words, causing yet another break of structure. But what I like to do here is to actually take the target just below the high. And why do I do this? Well, the reason is that the previous high, and especially in this case when we have a sort of two clear touches on this resistance area, it's very possible that the price can actually reverse once again when we come up to this resistance. So especially in this case, it can make sense to take your target just before the resistance. So even if the price goes up and tests the resistance and then falls, we still lock in profit. Alright, so this video was actually just a very short clip from our full smart money trading course right here on YouTube. To watch the full course, simply click or tap on the screen right here. I hope I will see you all over there very, very soon.